We're going to be taking a look at investment opportunities in the fixed and global bond market. What is going on there right now? Because everybody's been anticipating rate cuts, but seems they're delayed.
Right. So we've seen where the market has been pricing in rate cuts for as early as March in 2024. That hasn't really materialized, and the market has somewhat adjusted its expectations. I think now most persons are expecting the Fed to actually start making adjustments closer towards the end of the year. A surprise move we had last month, where ECB and Bank of Canada, they actually cut interest rates by 25 basis points. The market is a little bit skeptic about it, especially given that at the last reading, Canada's CPI numbers actually went higher. And I think we can all agree here that the main catalyst that most persons are looking at, especially the central bank, is where CPI numbers actually turn out. Even on the domestic side, you see where in all of the speech that our governors make, they talk a lot about inflation being outside of what the expected parameters are. For us, I believe it's somewhere in the 4% region. In other developed economies, it's a little bit lower, but as it stands now, we are still a little bit higher than what most central banks would like to see. Now, what it means is that while rates remain relatively high, emerging market debts are likely to continue to remain a little bit pressured. Prices are, inching towards the downside. And we've seen that in our regional bonds down as much as 5% year to date so far. There are some anomalies in between, but on average, most of the regional curves are actually pricing down in terms of price movement, which means that yields are actually higher. Now, we can always talk about, what is, but there are always opportunities inside of this, because when you canvass the market, the expectation is that we are somewhere at the peak, and some are more aggressive to say that it is impossible to price in any rate adjustment towards the upside right now. So if we are there and looking to go south for interest rates, it means that bond prices are being positioned to actually go higher, because the relationship is that yields fall, prices go higher, and that's where most persons would pick up the capital gains. Now, what it means is
bond prices are positioned to go higher than they are right now.
Well, if yields are supposed to go lower, then yes, prices would go higher. Because remember, the relationship is that when interest rates go higher, right, bond prices go lower. When interest rates go down, bond prices go up. So the existing bonds are likely to price higher. Now, what it means for some corporates, especially with the prospect of interest rates going lower, is that those persons who've been holding out on the high interest rates regime, they really don't want to be raising capital at these levels. At some point, in the near future, you will start to see those companies actually come into market to raise capital. There are some too who have bonds outstanding who may actually look to call those instruments, assuming that they have a call feature in them, right? And for those who trade a lot of the financial stocks, the lowering of interest rates may mean that net interest margin for those companies might actually start to improve. And then, on the stock side, you might see where, opportunities start to present themselves, because those companies are reporting better numbers in the near term. Of course, it's not all a blanket, because there are blips that we may see in between, because up to last year November, most persons would have been pricing that we would have been getting the rate cuts, and prices went up, but some of those cars are actually turning out to be a little bit expensive. But overall, the market is still pricing in that within the near term, especially towards the end of the year, rates are likely to be adjusting towards the downside.
So we have basically between now and the end of the year to take advantage of where rates are now.
It's a relatively safe bet, but what you want to be keeping a close eye on, and the central banks will always say it, especially when you listen to the Fed speech. Those analysts are, or the governors, sorry, they're always talking about reliant on data driven, and the data they're looking for the most part is inflation. The jobs market is relatively strong. We see changes sometimes that head in the direction, but for the most part, it's fairly stable. But on the inflation side, it's not adjusting as sharply or as strongly in the direction that they would prefer.
I have a question from Sean. Wants to know, when rates do get cut, how long would you estimate it would take for the market to react and we begin seeing some changes?
So usually you'll have speculation, and we would have seen that from last year, right? So there would be portfolios that would have positioned in anticipation of, right? And even this conversation is there may be hints that speculation can actually take place, but normally the smart money acts ahead of the announcements, and you find that sometimes there's a trailing that happens. So even when you look at the yield curve, there's some inversion, meaning that towards the shorter end you can pick up higher yields, and then yields actually start to level off. On a normal circumstance, yield curve kind of slopes up. The reason why we're seeing the inversion right now is because there are buys that are already positioned towards the longer end of the curve in anticipation of rates actually starting to come down. So you will see adjustments start to happen ahead, and then sometimes, well, at all times, when the action actually takes place, the rest of the market starts to adjust accordingly.
Next question comes from Javon. When can we see the return of USD paying dividend bonds?
USD paying dividend bonds. So it's a tough one, because it depends on whether or not I don't want to say regulatory wise we're capped on that, but some companies would prefer to actually continue to raise capital in Jamaican dollars. Why? Because it's cheaper. You're not exposed to the exchange rate movement. So from that perspective alone, you might find that it's a better alternative to raise capital, and it's safer and cheaper, right? On the US side, it's a little bit more difficult. While it becomes attractive, it costs a little bit more in the long term for companies who actually look to raise capital on that side.